Welcome back to Investing Talk Podcast.
Today we're looking at Lockheed Martin.
As usual, before we start, subscribe, like, and comment to this video to support the show. Okay, so let's unpack the macro environment we find ourselves in right now, because context is absolutely everything for this one.
It really is.
Right. For those of you tuning in, we are sitting in early March 2026. And if you've glanced at any screen recently, you know that geopolitical tensions are just completely dominating the news cycle, specifically the recent U.S. and Israel strikes on Iran.
Yeah, you can't ignore it.
No, exactly. Now, as always, we look at these global events impartially, strictly through the lens of market mechanics and capital flow. But, I mean, there's no denying that the landscape has shifted dramatically, and that shift is forcing capital to move fast.
What you're seeing right now is a classic, aggressive, risk-on rotation, specifically into defense equities. When global instability spikes like this, allied nations don't just put out press releases, right? They urgently accelerate their defense spending.
They open the checkbook.
Exactly. Budgets that were being debated over a timeline of years are suddenly getting rubber-stamped in weeks. And it's important to understand why this capital flows so predictably to specific players. In conflicts involving advanced aerial and missile exchanges, you see an immediate depletion of highly complex interceptors.
Like the Patriot missiles.
Right. Patriot missiles, the Age systems, precision-guided munitions. These aren't items a government can just buy off a shelf at a hardware store. They require specialized, highly secure manufacturing lines to restock.
And when institutional capital looks for a flight to safety trade that also offers massive growth potential in this specific environment, Lockheed Martin naturally becomes the absolute center of attention.
Yep.
I mean, they're the prime beneficiary of this global urgency because they manufacture the exact consumable defense products that are currently being depleted and urgently reordered.
They're sitting right at the intersection of geopolitical necessity and massive government appropriations.
They really are.
Yeah.
But before we get too swept up in the macro narrative, let's look under the hood at the fundamentals, because the numbers here are telling a really fascinating story.
Oh, absolutely.
If we look back at the 2025 performance, the company brought in $75 billion in sales. That's a 6% year-over-year growth, which is solid top-line expansion in what was actually a pretty challenging macro environment for manufacturing.
Definitely.
And they posted $5 billion in net earnings, which translates to $21.49 per share. But, and this is where I have to put on my skeptic's hat for you for a second, we have to note that this earnings figure includes a massive $479 million pension settlement charge.
Yeah, the pension hit.
Right, that is a significant hit. So how are we supposed to read the true earnings power here?
Well, that $479 million charge is exactly why we have to peel back the layers on headline numbers. That charge is what we call a one-time item. It's not a recurring operational expense. It's equivalent to about $1.63 per share after tax. So when you adjust for that one-off event, their normalized earnings power is actually materially higher. The reported earnings per share is arguably understating their true operational performance on the factory floor.
That makes sense.
But here's where the growth narrative gets incredibly compelling for you as an investor. It's the forward guidance. Management is projecting roughly 5% sales growth for 2026. Steady, dependable, but not explosive, right?
Right.
But alongside that, they are projecting a massive 25% segment operating profit growth.
Wait, I need to stop you there. 5% sales growth, but 25% operating profit growth.
Yep.
That is a massive delta. How does a company's profit grow 5 times faster than its actual revenue? What does that actually mean for the listener analyzing the mechanics of this business?
It means huge margin expansion, which is the textbook definition of operating leverage. To explain it simply, imagine you run a bakery. Your rent, your ovens, your core staff, those are fixed costs.
Right, they don't change.
Exactly. So if you sell 10% more bread, your revenue goes up 10%. But because your fixed costs didn't change, your actual profit on those extra loaves might jump by 50%.
Wow, okay.
Lockheed Martin is essentially doing that on a multi-billion-dollar scale. They are successfully executing rigorous cost reductions across their supply chain. Furthermore, a larger mix of their revenue is shifting toward higher margin programs.
Like the classified stuff.
Specifically, their highly classified contracts and very lucrative international sales. They're simply making significantly more money on every single new dollar coming in the door.
Okay, that definitely makes the earnings trajectory look a lot more robust. Now let's talk about the cash position, because maintaining a fortress balance sheet in a capital-intensive, heavy manufacturing industry is no small feat.
That's huge.
In 2025, they generated $6.9 billion in free cash flow, and that was after making an $860 million pension contribution to fulfill their 2026 obligations early. Looking ahead, they've actually raised their 2026 free cash flow guidance to between $6.5 and $6.8 billion.
That free cash flow profile is incredible when you benchmark it. It represents roughly 9% of their total revenue. In the heavy manufacturing sector, that is substantial dry powder.
Right, and just to clarify for everyone, dry powder essentially means they have a massive pile of highly liquid cash ready to deploy.
Exactly. It means they can self-fund their own growth, invest heavily in organic research and development for next-generation weapons, and still have plenty of capital left over to return directly to you through healthy dividends and aggressive share buybacks.
Which investors love.
But honestly, the real crown jewel of this fundamental thesis isn't just the cash sitting in the bank, it's the backlog. At the end of 2025, Lockheed Martin reported a record-breaking $194 billion backlog.
$194 billion in the backlog. Let's just pause on that number for a second because context is everything here. Just put that in perspective for you. That is roughly equivalent to the entire gross domestic product of a country like New Zealand.
It's wild.
Just sitting in Lockheed's waiting room, already contracted and waiting to be built.
The scale is staggering. And here is why it matters so profoundly to your investment thesis. That backlog represents roughly 2.6 years of pure revenue visibility at their current production run rates. Think about the economic buffer that provides.
Massive.
If there's a sudden global demand shock, or a severe macroeconomic recession, or a supply chain freeze that halts new orders, they still have over 2.5 years of guaranteed, federally contracted work waiting to be built.
Yeah, it gives them highly predictable revenue streams. It massively dilutes their customer concentration risk. And crucially, it gives them immense pricing power when they sit down at the table to negotiate new contracts because they simply aren't desperate to keep the lights on. They can demand premium margins.
Exactly.
Which brings us to their competitive moat, because you don't build a nearly $200 billion backlog without some serious structural advantages that keep competitors completely locked out. First off, you have these irreplaceable classified programs. They operate so deeply within the U.S. national security apparatus that the switching costs and regulatory barriers to entry are basically insurmountable. A nimble tech startup in Silicon Valley isn't going to suddenly disrupt a classified hypersonic missile program.
Not a chance.
They don't have the security clearances, the facilities, or the decades of institutional trust. You also have total vertical integration. As a prime contractor, Lockheed controls the critical supply chains, propulsion systems, advanced avionics, radar components, which effectively boxes out smaller competitors who have to rely on third-party suppliers.
And let's not overlook the platform ecosystems themselves. Take the F-35 fighter jet program or the Sikorsky helicopter division. This operates on what is essentially the razor and razor blades business model.
Give away the handle, sell the blades.
Exactly. When allied nations buy a squadron of these aircraft, they aren't just making a one-time hardware purchase. They are locking their militaries into 30 or 40 years of aftermarket recurring revenue for Lockheed Martin. We're talking about mandatory airframe maintenance, continuous software and avionics upgrades, pilot training simulators, replacement parts.
Right.
That is highly predictable, exceptionally high-margin recurring revenue with almost zero churn, because you can't exactly take an F-35 to a local mechanic down the street.
Very true.
And overlaying all of this is the political reality. Defense budgets in the United States are deeply entrenched bipartisan priorities. Lockheed's manufacturing footprint strategically spans so many key congressional districts across the country that their political support is virtually guaranteed, regardless of which party controls the administration.
Yeah, they've engineered their supply chain to be politically bulletproof.
Yeah.
With all of that fundamental armor in place, pivot to the charts, because we need to see how all these underlying mechanics are actually translating into price action.
Let's do it.
The momentum we've seen recently is nothing short of violent. On January 2nd of this year, 2026, the stock opened at $497.35. By January 14th, just 12 days later, it had surged to $572.71.
It's a massive move.
We're talking about a 15% jump in under 2 weeks. For a mature mega-cap defense contractor, that is an incredibly aggressive move upward.
To contextualize this massive price action for you, you really have to look at the broader sector dynamics. The defense sector index as a whole is up an astounding 35% since the initial geopolitical catalysts back in June 2025.
35%.
Yeah. What you're seeing on the charts right now is massive institutional volume pouring into the space. Huge mutual funds and pension funds are rapidly repositioning their portfolios. And because Lockheed Martin is the largest, most dominant pure-play defense contractor out there,
Meaning they focus almost exclusively on defense.
right, unlike a competitor like Boeing, which is heavily exposed to commercial airlines. Because of that pure play status, they are capturing a highly disproportionate share of that flight to safety capital. When a portfolio manager gets the mandate to reduce overall market risk and immediately increase defense exposure by the end of the week, they don't overthink it. They click the buy button on the biggest, most liquid player in the room.
That makes total sense.
Yeah.
That kind of technical chart action is great. But shifting over to market sentiment, things aren't totally flawless here.
Okay.
We need to look at a recent hiccup that should logically give investors pause. In their Q4 2025 earnings report released in late January, their earnings per share came in at $5.80. Now, the Wall Street consensus estimate was $5.94, so they missed expectations by over 2%.
They did.
I have to push back here. In a hyper-scrutinized, highly valued market, a miss is a miss. Why should you, as an investor, trust their rosy 2026 guidance when they quite literally just fumble the ball in the final quarter of 2025? Doesn't that cool the bullish sentiment?
It's a fair challenge, but you have to look at how institutional capital actually processes that kind of short-term noise. Overall sentiment remains firmly neutral to bullish despite that miss.
Why is that?
Because forward guidance almost always outweighs a trailing quarter's slight underperformance. When management stepped up to the microphone and raised their 2026 profit growth guidance by 25% and simultaneously raised their free cash flow guidance, that acted as a massive implicit signal of operational confidence.
Right.
It's essentially management telling the street, yes, Q4 was a bit noisy due to the timing of deliveries, but look at the sheer wall of cash we are about to generate over the next 12 months. In the minds of institutional investors, that forward-looking confidence easily overpowered the slight earnings miss.
Okay, assuming the market remains a forward-looking mechanism, let's talk about the specific catalysts and innovations driving that forward optimism. We just saw a major strategic win with a foreign military sale to the Royal Australian Air Force, specifically for supplying C-130J training devices and block upgrades.
Yeah, that's a great example.
It proves that the international demand narrative isn't just theoretical, right? It's actively converting into signed contracts. But here is where the story gets really futuristic and honestly fascinating. They just announced a new research initiative with a quantum computing firm called Xanadu.
This is critical for you to understand if you are looking at the long-term horizon of this company. This partnership with Xanadu is focused entirely on quantum machine learning for national security use cases.
Quantum machine learning.
Yes. To understand the leap here, classical computers, even the most advanced supercomputers, process information sequentially. Quantum computers use quantum mechanics to process massive, multivariable problems simultaneously.
So what does that mean for a defense contractor?
In a modern battlefield context, we're talking about utilizing quantum algorithms to optimize incredibly complex global supply chain logistics in real time, instantly decrypting intercepted enemy communications that would take classical computers thousands of years to crack, and optimizing drone swarm targeting at speeds current systems simply cannot touch.
That's incredible.
By planting their flag aggressively in quantum computing right now, Lockheed is positioning themselves at the absolute frontier of defense tech innovation. They are proactively ensuring they don't get relegated to being just a legacy metal bender as artificial intelligence and quantum mechanics completely reshape modern warfare.
All right, let's flip the script and look at the risks, because no investment is bulletproof no matter how good the charts or the futuristic tech looks. We need to do a rigorous check of the downside.
Let's do it.
Let's dig into some highly negative data points regarding execution risk. In 2025, the company recognized $950 million in what they call reach-forward losses on a classified program. Plus, they took another $140 million in unfavorable adjustments on the C-130 program.
Yeah, that was a tough pill to swallow.
For those listening, a reach-forward loss essentially means management has identified that a multi-year contract is going to cost far more to fulfill than they will actually get paid for it, and accounting rules force them to take that entire financial hit up front.
Wait, Over $1 billion in combined losses on program execution is a massive red flag.
It is.
You can't just gloss over that. What if these severe program overruns continue and completely compress those 2026 margins you were praising earlier?
You're hitting on the exact nerve that keeps their executives awake at night. It is unequivocally the top internal operational risk for the company. Complex, multi-year, multi-billion-dollar aerospace engineering projects naturally carry extreme execution risk. Building never-before-seen technology is really hard.
Right.
However, the mitigation thesis here goes right back to that 25% operating profit growth guidance for 2026. For management to confidently project that aggressive level of margin expansion immediately after taking those massive hits in 2025, it strongly implies that they have already baked highly conservative execution assumptions into their new forecasts. So they lower the bar.
Exactly. They've likely done what Wall Street calls kitchen sinking. This means they threw every possible piece of bad news, anticipated overrun, and expected loss into the 2025 numbers, so that 2026 looks like a clean, highly profitable slate. If their engineering execution actually improves even slightly, reverting back to their historical norms, there is likely massive upside to those projected profit numbers because the bar has been set so low.
That makes sense from an accounting perspective. But that brings us to the external macro risk. Right now, there is an undeniable massive fear premium baked into defense stocks because of the specific U.S. and Iran situation we discussed at the top of the show.
Yeah.
So what happens to this stock if geopolitical tensions suddenly cool off? What if there is a surprise diplomatic breakthrough next month and that urgent global anxiety evaporates? Doesn't the floor completely fall out from under this 15% rally?
The deflation of that fear premium is the top external risk, absolutely. But you have to zoom out and look at the broader structural factors driving global defense spending over the next decade. Iran is a massive immediate catalyst right now, but it is by no means the only pillar holding up this market.
Right, there's a lot going on globally.
You have China's historic, unprecedented naval and aerospace military buildup in the Pacific. You have the rapid expansion and mandated rearming of NATO nations who have chronically underfunded their militaries for decades. And you have the ongoing, persistent structural tensions surrounding Taiwan and semiconductor supply chains.
Yeah, those aren't going away next month.
Exactly. These massive geopolitical realities provide a multi-year, ironclad floor for defense spending, regardless of what happens diplomatically in the Middle East in the short term. And again, if global demand does momentarily soften, they have that $194 billion 2.6-year backlog acting as a giant financial shock absorber. They are highly insulated from short-term geopolitical cooling.
So, bringing it all together for the final verdict, we've unpacked the macro environment, the fundamental operating leverage, the massive $6.9 billion in cash flow, the violent 15% price surge, the futuristic quantum partnerships, and the very real execution and geopolitical risks. Where does the final quantitative score actually land for the listener?
Based on the rigorous synthesis of all this data, balancing the near-term technical momentum with the long-term fundamental backlog, the final bullish score comes in at a very strong 8.5 out of 10. For you as an investor, this presents a really compelling, highly asymmetric dual horizon opportunity.
Let's break down those two specific horizons so the listener knows exactly what timeframes we were looking at.
In the near-term horizon, this acts as a highly attractive swing trade. You are essentially riding this massive geopolitical tailwind, the institutional capital rotation, and the anticipated positive momentum directly into their Q1 2026 earnings report, which will hit the wire in late April.
Okay, so that's the short game.
Right. The target zone for that near-term swing trade sits comfortably between $600 and $620 per share. That represents a solid 5 to 8% upside from that mid-January closing price, with relatively low downside risk given the sector rotation.
And the long game.
Then you have the medium to long-term horizon. If you are looking at a 2 to 3 year hold, you are targeting 15 to 20% annualized returns. That longer-term appreciation is going to be driven by the steady, relentless conversion of that $194 billion backlog into actual billed revenue, combined with that massive 25% operating margin expansion we discussed.
Plus the shareholder returns.
Exactly. You have to add the 10 to 12% total annualized returns you can expect from their very generous, highly reliable shareholder dividends and aggressive share buyback programs. When you put all those pieces together, it operates as a highly robust compounding machine.
Before we wrap up, I want to leave you with a final provocative thought to mull over as you do your own research. We spent some time talking about their new research partnership with Xanadu, but play that specific technology out a decade from now. If that quantum machine learning initiative succeeds and fundamentally revolutionizes how global military logistics, encrypted communications, and autonomous targeting systems operate, could proprietary quantum infrastructure become an entirely new, currently unpriced structural moat?
It's a massive question.
Could it completely redefine what a defense contractor even means in the late 2020s and beyond, moving them away from being just a traditional aerospace manufacturer and transforming them into a pure, untouchable technology monopoly? It's something critical to think about as you watch this company evolve over the next few years. As always, thank you for tuning in. Subscribe, like, and comment to this video to support the show, and we'll catch you on the next one.